My name's Brady Plunkett, and Jordan Tarasoff and I, who are advisors at PWL Capital, are incredibly happy and pleased to be welcomed into the Sienna community for today's presentation. And we look forward to sharing some insights and financial planning topics that are relevant for your particular phase of life. If we could go to the next slide, we'll be able to see an introduction of the types of topics that Jordan and I will dive into further today. Initially, we'll start with some sources of public pension income that likely form part of your retirement income as Canadians. A lot of times we get asked, when is a really good time to invest given the current state of the markets and other considerations, which we will also touch upon. We'll also discuss some certain strategies that you might consider as you aim to create a retirement income, and what kind of approaches you might take to build an investment portfolio that's right for you, all while being mindful and cognizant of the costs of investing, which absolutely play a critical role in a successful experience. And we'll end off with some ideas and insights in how you might create your own pension should you might not have access to a defined benefit pension income. So we'll get started with that. So the first area we'll dive into is the Canada Pension Plan. These are benefits that are taxable, do get indexed to inflation with the rate of CPI every January, and the amount you received from a CPP pension is unique. It's a function of what your historical contributions into the Canada Pension Plan were as an employee from your years of working, along with the chosen application date between age 60 and 70 that you decided to apply for your CPP pension. This is just an overview of the main characteristics of the program. If we move to the next slide, one interesting perspective and insight that might be relevant for your situation is that your Canada Pension Plan benefits can actually be shared with your married spouse or common law spouse. Having said that, the amount of the CPP pension that is eligible to be split can only come from credits that were accumulated and built up during your marriage. Any CPP contributions and credits that are identified before the relationship existed are not eligible to be split. In order to do this, you should apply. An application is required. This arrangement can be canceled anytime, but the reason that you might want to consider this is that it might lead directly to some tax savings between you and your spouse if the opportunity and arrangement allows for a more balanced income tax picture after the splitting arrangement is pursued. And if we move on to the next section of this CPP umbrella, a lot of times we get asked, right now, myself and my spouse are collecting CPP, but if something happens to either one of us, what happens next? And what does the income from CPP look like as a standalone survivor? The CPP survivor benefits are definitely not straightforward. They're relatively complex, but to simplify it, we can do so in a number of steps. Number one, the CPP survivor benefits will look for what the deceased's age 65 CPP pension should have been. As a second step, if we look to the table on the right, they will subsequently look to what age the survivor is and subsequently calculate a survivor pension according to the basic formulas that you'll see on the right-hand side, depending on whether you're older or younger than age 65. The key thing to keep in mind is with a CPP survivor benefit, there is a flat cap maximum amount that one single pensioner is able to collect on their own. Now, you can only collect one survivor income should you survive multiple spouses. And the good news is you don't actually lose this if you decide to get married again. These payments or these CPP survivor benefits are accepted on a retroactive basis for up to 11 months. So the executor of one's will should be aware of this opportunity and apply for it and have it become part of your retirement income as part of the executor's responsibilities of administering a will. And if we're to move along here, the other responsibility that an executor of one's will should be cognizant of as it relates to CPP is that there is an available CPP death benefit. It's a lump sum payment of $2,500 that is taxable and do come with a few qualification, does come on a qualification basis according to the two lines that you'll see on the screen underneath there. And again, this should be applied for soon after one is deceased. We would recommend within 60 days of the date of death. And now we'll give it to Jordan to dive into the old age security benefit.
Thanks, Brady. So in contrast to Canada Pension Plan, which you and your employer both contribute to throughout your working years, old age security is actually just based on Canadian residency. So if you lived in Canada for more than 10 years after age 18, you're entitled to some benefit. And if it's 40 years after age 18, you're entitled to the full benefit. Something people miss is that if you leave Canada for more than 6 months, you can actually have your benefit stopped and need to reapply when you come back. However, this only applies if you're only collecting half the maximum benefit. So that would be 20 years after age 18 or less. If you're getting more than that, you can leave Canada for as long as you like and still keep collecting old age security. Just like Canada Pension Plan, it goes up with inflation and it's adjusted quarterly. But if for some reason things become less expensive, they're not going to cut back your benefit. So it only gets ratcheted up or stays the same. And in contrast to Canada Pension Plan, there is no death benefit with old age security. So if this is a large portion of your retirement income, if one partner is to predecease the other, that income is lost with no makeup payments and with no lump sum. If we go to the next slide, we can see that all Canadian residents are offered OAS, but not everybody gets it. If your income is over a certain threshold, they start clawing back the benefit. So at around $80,000, each additional dollar of income that you make, you do pay tax on, but you also lose 15% of your old age security. This can be thought of as almost like a penalty tax. So for your average person working, making $80,000 a year, they pay about 31% tax on the next dollar of income. But if you are collecting old age security, you pay about 15% more than that. So some retirees can end up paying more tax when they're retired than they ever did in their working years. So with this old age security clawback limit, we need to be very careful about not going over it. The nice thing is when you're retired, sometimes you have some flexibility on how much money you make and when you make it. That's especially true when it comes to using RSPs or locked-in RSPs, which after age 70 become RIF accounts or LIFs, retirement income funds. So a traditional RIF, the amount you need to take out of the account increases each year. So in your 70s, it's around 5%. Then as you age into your 90s and beyond, it climbs all the way up to 20%. In this slide here, we can see a hypothetical example where a client has a RIF account, is taking money out, just the minimum, and you can see the OAS callback plotted in red along the chart. What happens here is that they're taking out less than the OAS callback when they're younger, but much, much more when they're older, losing a large amount of their benefit. If we go to the next slide, what we can see is this client might benefit from smoothing those withdrawals out over time. So rather than taking out the minimum in each year, we might run an analysis and decide to take out more from their RIF accounts while they're younger, but staying below that OAS clawback limit. That way, less money is subject to that additional penalty tax in their later years. Yes, they pay more tax today, but over the lifetime of their retirement, they end up paying less tax because they avoid that OAS clawback penalty. Moving on to the next section, a really common question we get is, hey, when should I invest? Things look expensive. The markets looks choppy right now. Is now a good time to put money in? If we go to the next slide, back one. So this is very common when someone sells a property, sells their home, sells a business, gets an inheritance. Oftentimes clients are dealing with a large lump sum of money and the regret from putting that in at the wrong time can be immense. You pick a bad day in the markets to put your money in, you might end up losing percents over the next few months. We saw that in March with the COVID pandemic. So what our team did was we compared, if we take 10-year rolling periods through history, so starting in 1926 to 1936, and then we move forward 1 month, and we do that over and over again, were you better off investing all your money all at once or putting in 1/12 for a year? So incrementally going in the markets. If something bad happened and you're doing it incrementally, that's great because you get to buy in at a low. But if the markets go up, you did miss those opportunities because you weren't invested all at front. So we compared those two situations globally, and on the next slide, we can see our results. So 2/3 of the time, you are better off investing as a lump sum than you were investing gradually over a year. And this is generally a rule of thumb in investing is the more time you spend invested, the better your expected outcomes. When you're investing over a year, a lot of your money spends its time sitting in cash, and there's always a positive expected return to being invested in the markets. However, the regret from putting the money in at the wrong time, because 1/3 of the time you were worse off investing the money all at once, that regret can be quite taxing for investors. Rather than trying to time the markets, what we try to focus on is picking a portfolio that you can handle the ups and the downs and be comfortable putting the money in all at once. Brady will give a bit more explanation on how we construct a portfolio of that structure.
Yeah, that's great, Jordan. So a lot of times what we hear from retirees is, I've got my Canada pension plan, I've got my OAS, I'm retired now, and I've got this portfolio. What is a sensible way to create a retirement income from this nest egg that we have accumulated over the years? Sometimes what we hear is a preference for those who like to target specific companies when creating an investment strategy that pay dividends. I think it would be really helpful to go over exactly what a dividend is and what it means and how relevant they are. So suppose any company in the world, let's think of just Royal Bank as an example. They're running their own business operations and they have some corporate cash left over at the end of a certain reporting period. They can do a number of things with that cash. They can pour it back into the business by reinvesting in a number of different projects that they're interested in, or they could also give or pay a dividend to their investors. They do this because they appreciate the initial investment that all of these investors have given them upfront by injecting their cash into their company. Now that feels good because dividend, especially dividend cash, it's a source of income and it's something that you can see, you can feel, and you can rely on. And that's great. But the reality is when you're thinking of building an investment portfolio, there's some things that you need to be cautious of when relying specifically on dividends. Number one, they're just equities. So as we'll see in a future slide, a typical portfolio has a combination of risky assets and more stable assets in creating that investment experience for you. By targeting just dividends, you are not becoming the most, you are not pursuing the most diversified investment approach that you could have, because not every stock in the world pays dividends. You are excluding a number of different companies in your investment strategy if you're only picking the ones that choose to pay dividends. The other key point that we want to think about is, although they actually do pay cash, dividends are actually pretty irrelevant when thinking of the overall performance of a certain stock or a certain company, because returns don't always just come from dividends. I'll give you an example, and we'll go back to the Royal Bank again. And this is tough to observe because stocks are trading pretty consistently throughout the day. But let's suppose that Royal Bank is trading at $100. It's not necessarily, but just for the example. When they decide, let's say they decide to announce a $1 per share dividend to all of their investors, what actually happens for a blip for a moment in time is that $100 share price for Royal Bank will go down to 99. So it's not a free lunch by any means. That dividend that investors are getting incentivized for is coming out of the actual share price of the number of shares of the specific company that they own in the first place. That's on the investment strategy side. If we move on to the next slide of dividends, we'll actually see that when we're thinking about taxes for retirees, these might not be the most efficient, the most efficient approach from a tax standpoint. And let me explain what that means. So when dividends are paid in a taxable investment account, outside of a RIF, outside of an LIF, and outside of a TFSA, they are actually taxable on your tax return. The problem is they will show up on your tax return and they are boosted by 38% of what the actual cash dividend was, and they are taxable to you. Where this becomes problematic is that it can actually get in the way of keeping your OAS. Jordan explained in a previous slide that there's a certain income tested threshold where there's a 15% super tax on your OAS. But by having all of these dividends appear on your tax return, that poses another challenge to actually keeping this pension and avoiding that extra tax bracket that he's talking about. Even more so, if you were to pursue a dividend specific approach, you might be paying all of this tax on all of this cash flow, and you might not even be spending it. So you might not, so not only does it make it more challenging to keep your OAS, but you might be paying tax on income that you don't even need. Yes, we want to highlight the point and give dividends their due because they do provide a tax credit available, and this is fantastic. The problem is that tax credit is only recognized on Canadian companies. And on the next slide, the threat of making sure that it's only Canadian companies, we are going to see, back to the diversification piece, is that Canada actually represents only 3% of the world stock market. So this chart that you're looking at is as of 2020, and it's the entire world's stock market, not economy, stock market. So back to diversification, by pursuing only Canadian companies, you're only getting 3% of the world. But by pursuing Canadian dividend paying companies, you're actually getting less than the 3% of the opportunity set, which is why we don't focus only on dividends when constructing an investment strategy. If we keep moving along, the next question that might come up, and does come up for us all the time, is, okay, fair enough. Dividends might not be the be all end all answer in creating an investment strategy. I get it. So what is? When we think about a sensible approach to building an investment portfolio, we want as broadly diversified of a portfolio in global stocks and global bonds as possible. One of the things that we want to get to before a portfolio is actually constructed is having a really good understanding of what your goals are and what it is you're looking to accomplish with your wealth, because that is the framework for how this all comes together. After your goals are properly identified, what we would recommend is making sure that you build a financial plan for this base of wealth to ensure that your goals are aligned in a specific detailed way for how you expect them to add value to yourself or for your loved ones over time. Once we have the goals and once we have the plan, we can start by developing an asset allocation of stocks and bonds, which is better summarized on the next slide. Stocks and bonds, just to review, stocks are your ticket, your claim to the earnings of thousands of different companies that trade publicly on stock exchanges in the world. You are becoming an owner in thousands of different businesses, and you get to participate in the success of how their revenues grow over time. Bonds have different risk characteristics associated with them. I'm not even sure risk is the proper word. These are more stable investments where you're not being an owner in businesses, you are choosing to actually become a loaner in a number of different governments and corporations all over the world. And I'll highlight this with an example as well. Pretend that there is this one colleague, there's this one friend that for whatever reason in your lifetime, you have given them some money And you know when you're giving that money to them that there is an uncertain chance that you are ever going to see it back. We like to think of this in the bond market as credit risk. Credit risk is for riskier or for riskier sources of borrowers. You should demand as an investor a higher rate of return or a higher interest rate in exchange for lending your money there. The other factor that's important in investing in bonds is time and duration. So for example, even if it's someone that's super reliable in your life and you give them if you give them some money to lend them some money, you should demand a higher interest rate for lending your money if you agree to get paid back in 20 years versus if you can get paid back in 1 year, because a lot can happen in 20 years. And in 1 year, we have a more reliable sense of what could happen. And you can probably imagine that they are going to be there to pay you back. So those are the characteristics of how risk and return are related in the bond market, also known as fixed income. And if we keep moving along, this is a graphical representation of the past slide in terms of stocks and bonds. This looks at the growth of one single dollar from 1985 and looks at how that accumulated and grew by the time 2018 was wrapped up. You can see that $1 for stocks or world equities, that's the blue, turned into $23. That $1 turned into $7 for short-term bonds, $4 for treasury bills, and just $2 if you were measuring inflation across the economy. That is a great picture on the return aspect of it. But in order to get paid that $23, just to highlight the risk part of this, you have to go for the ride that the blue line graph is actually sharing. And yes, over time, you can see that there are increases, but what you have to put up with in order to get that $23 is a number of different declines, which represent different times of market recessions and extreme volatility in the equity markets. In contrast, you'll see underneath the green and the gray, you don't have to put up with the swings and the ups and the downs. You are getting a more stable outcome, which seems comforting. But the reason that you would put up with those swings to begin with is because you would get paid over time much more than if you didn't. And if we were to keep going here, Maureen, what we're going to look at here is a Monte Carlo analysis. So you're retired and you've got sources of income and you have an investment portfolio that you have accumulated in terms of a nest egg that you are looking to draw on for your remaining retirement needs. Fantastic. A nice story that you can assign to this chart is, let's say two different retirees retired at the same time at their age 65, and they bump into each other at their own retirement party. And they've each got $1 million. They each expect to live to age 90, and they each want to take out $50,000 a year. What makes it more interesting is if they catch up by the time they turn 90 and they look at each other and they go, hey, you know what? I actually remember that party we went to and we were talking about all this? Turns out I got a 6% return. And then their neighbor subsequently responds, hey, so did I. I had a really bad experience. How did you do? What's super interesting is that it matters less at what your average annualized return is going to be at the end of this, but it matters even more at the timing and the sequence of when these returns are actually received. In example one on the left-hand side, you will see that neighbor number one experienced fantastic returns early on in their retirement, but towards the end of their retirement, when they were aging, that is when the more bear markets started to show up. The result is they ended at age 90 with $2.5 million. Neighbor two on the right-hand side also started with their $1 million, same thing, $50,000 annual withdrawals, but experienced significant bear markets or negative or declining markets in their early stages of their retirement. Mind you, they did not adjust their draws. They continued to withdraw from their accounts, but the good years came later in their retirement in their 80s. The problem is, since they didn't adjust those draws to match the type of market environments that showed up, they actually ran out of money by their age 80, what is that, 82. They didn't end up with 2.5 million when they got to 90. They ran out about 8 years earlier, which is such a powerful idea. So when we do retirement planning, and when we think about how to properly think about that, what we use is a Monte Carlo analysis. I smile because there's that casino thought that comes into mind when I think about this. But what a Monte Carlo is really helpful with is simulating what the experience could be for either scenario. They run hundreds and hundreds of different trials, in this example, from age 65 to age 90, to stress test these $50,000 withdrawals against the types of market conditions that are possible for a retiree. And typically when we do these, we look for about an 85 to 90% success rate, but that success rate is pretty subjective, subject to what your comfort level is. And we'll wrap that up, Maureen, and give it to Jordan to talk about the costs associated with investing.
Thanks, Brady. So just to recap what we've tracked through so far, we talked a little bit about government pensions, where they come from, how much you can expect to keep long-term, the clawback limits as well. And then we also chatted about when to invest and said that the numbers say investing all at once is better than investing over time. Brady touched on dividend investing and said investing specifically for dividends is not necessarily our favorite approach. We prefer to invest in the market as a whole, and then use Monte Carlo analysis to see if our ratio of stocks to bonds and our current spending rate is appropriate. That's a lot of financial planning. When it comes down to, okay, I like this strategy, I want to do it. Now, who do I invest with? Where do I invest my money? What most people do is they'll hire somebody to do it for them. They'll find a portfolio manager or a mutual fund or an ETF or something like a Wealthsimple, someone at the bank, and they'll go to them and say, I have this money, can you help me invest it? And what's very common in the industry is something called active management. So what active managers do is they say, if we take the entire market as a whole, I think that these companies are going to do better and these ones are going to do worse. These are good companies, these are bad ones. So what I'm going to do for you is I'm going to buy more of the good companies and I'm going to avoid the bad companies. And what will happen for you is you'll get better returns than if you were to take a passive approach to investing. And so very often I'll talk to clients and they'll say, well, my guy at the bank, he got me a 7% return. I think that's pretty good. But if you could have done nothing, just own the market as a whole and gotten 9%, then that might not be the best. If the market did -2%, then that's fantastic. So when looking at active management, what we need to do is compare it to a benchmark. We need to compare doing something expensive, doing research, looking into companies, hiring analysts, trading, to what if we just buy a little bit of everything and sit on it as cheaply as possible? Are we better off paying somebody to manage our money? And if we go to the next slide, we can see the results. So what this slide highlights is what percentage of active managers beat their benchmark. What percentage of active managers do better than just buying the entire market as cheaply as possible and sitting on it? And the most striking numbers are at the 5-year mark. We can see that almost 99% of active fund managers in Canada were unable to beat a passive approach. 100% of active managers will tell you their job is to beat the benchmark, but only 1% was actually able to do so. In international markets, it's not that much better. About 80% of active managers were not able to beat their benchmark. And the reason why is they're investing in the same stocks as the benchmark, but then charging you fees on top of it. So they need to not only do better than a benchmark, but do better than the fees that they charge as well. Very often we'll hear though, well, it's not about beating the market. The reason why I have an active manager is because if the markets drop, I don't want any part of that. I want to be safe in down markets. If we go to the next slide, we can see how do active managers actually do in down markets. So what this chart shows is the red line is 50%, and it alternates good market, bad market, good market, bad market, good market. And you can see that regardless of whether things are going up or things are going down, there is no evidence that having someone trying to predict the market, trying to say these stocks are bad, these stocks are good, results in any outperformance. There is no protection on the downside, and there is no opportunity to the upside. But what's interesting is we've seen that some funds do beat the market. So we're not going to go to our bank, we're not going to go to our advisor and say, hey, give me the bad funds. We're going to say, give me the ones that are good. Give me the ones that have beaten the market historically. On the next slide, we can see how that turns out. So we take the best performers, the best managers over 5 years. Only 80% of them stay in the top in the next 5-year period. If we look at fixed income, only 70%, or yeah, only 20% stay in the top in the next 5-year period. 80% fail to stay in the top percentile over the next 5 years. So if you look at the top performers, only 20% of them stay in the top in equities, and only 30% stay in the top moving forward. So if you look at all the best funds and say, I want those, there's a 1 in 5 chance that you're picking a good fund. The high likelihood is that those funds that you're picking from are going to be dogged in the following year. So looking at past performance has no predictive power on how funds are going to perform in the future. There is no way to look at how things have done in the past and say, that looks great, give me some more of that. But there is one thing that predicts future performance, and we can see that on the next slide. So what we did here was we arranged funds and we took the cheapest funds and compared them to the most expensive funds. So the cheapest funds are going to be in the blue and the most expensive is going to be in the green. And we can see that across everywhere from US stocks to Canadian bonds, across the board, the one thing that is correlating between performance, correlated with performance is cost, which is very counterintuitive because in day-to-day life, the more you pay for dinner, the more you pay for a mechanic, the more you pay for vacation, usually the better experience you get. But with investing, there's a cliche, a penny saved is a penny earned. That is true in investing because there are great active managers out there, but there's not great active managers out there who don't charge you for that service enough to erode all their value. So when you're looking at investments, if you line them up by cost, not by performance, that is a fantastic way to say, what do we think will do well moving into the future? And so if we're not going to hire active managers, the way we think you should invest is highlighted on the next slide. So 2021 is a great time to be an investor. There's so many cool index products available. So an index investment, there is no one deciding this company looks good, this one looks bad. Let's sell this and get out of that. Let's buy this because it looks ready to take off. What's happening is they're saying, here's a basket of stocks. We're going to own a little bit of a lot of stocks, and we're going to focus on keeping our costs really low. And what we're going to do is let the market price the stocks for us. So there's billions of dollars every single day reacting to news in the markets. So companies will release a press release, and one company will say, that's good. Let's buy more of that stock. And they'll say, that's bad. Let's bid it down. And this money will bid back and forth until it settles on a price. All that research, all that negotiation is very, very expensive. And you're going to end up benefiting from that pricing mechanism. We don't go to the grocery store and say, that doesn't look right for bread. I'm going to do some research, see how much wheat costs, see how much farmers are getting paid. I'm going to see if it's cheaper in different towns and negotiate. No, like the market prices things efficiently. That takes place in stocks as well. So rather than paying lots of money to try to beat the market on price, let's take prices as a given and then minimize our fees. That is our chosen approach to investing for everybody, regardless of whether you're 20 years old or 80 years old. It doesn't make sense to pay for active management. And then on the next section here, I wanted to chat a little bit about a topic that doesn't come up that much. It's not very popular, and that's a bit of a puzzle. So if we move to the next slide, defined benefit pensions, where you and your employer put money in while you're working, and then when you're retired, they promise to pay you a certain amount. I've never heard anyone who wasn't happy about that arrangement. With the sponsor, the employer, if say they have a big pool of capital, it's invested, it's supposed to pay you this regular income. If that pool of capital drops, you don't have to put money into it. The employer will put money into it to top it up. So all the risk is with the employer. For retirees who don't have a pension plan, are living off a pool of money, if the markets drop, they have to tighten, what's this expression, tighten their belt. They have to dial things back a little bit because no one's there to top up the money for them. But what's interesting is there's a way to pool risk in retirement. So for younger clients, very often we recommend life insurance because there's a risk they pass away too soon and someone needs money to be taken care of. With retirees, the risk is that something great happens. The risk is that you live a long, healthy life, but your money doesn't last quite as long. So what we typically recommend to clients is something called an annuity. And an annuity will provide a return to you in a way that individual investors on their own cannot recreate. So if we move to the next slide, I'll show you a simplified illustration of how an annuity works. So in this hypothetical example, 5 people get together and they all pool their money. They all put $100 in an account growing at 5% because all of them know they need money next year and are concerned that they're going to live a long time. At the end of the year, one of the people has passed away. So the other 4, they receive their $100 back plus $5 of interest, plus they receive money from the person who passed away. So it was a fantastic investment for the people who lived a long time, but it was a bad investment for the person who passed away. But it's the same as insurance. Most people who pay for insurance never make a claim. You're paying for it just in case you need it. With annuities, it's the same thing. You're paying for an annuity just in case you live a lot longer than expected. So all these people pool their money together. Some of them don't live extraordinarily long, but those that do profit from that risk pooling over long periods of time. So if this person was to invest on their own, they can get a 5% rate of return. But if they invest in a pooled system like this, you can see they take advantage of something called mortality credits. Mortality credits, it's a bit morbid, but it's the people who didn't get the insurance benefit from putting money into a program like this. And if we move to the next slide, this very often dramatically improves retirement plans, but people have a very hard time actually putting their money into an annuity. Sometimes it's because it's hard to compare a large lump sum. I'm going to pay $100,000 for $7,000 a year. Those don't seem to stack up. But if we look at the time horizon and the stability that provides you, sometimes it's a good investment. There's also something called the endowment effect, where people tend to value things they already have a lot more than things that they can purchase. So most people who have a defined benefit pension, they could take a lump sum instead of the pension, but they don't. Most people who could buy a pension, who could buy an annuity, would rather keep the lump sum because they already own it. There was a study in which they asked people, how much would you pay for a mug versus how much would you have to sell a mug you already own for? Yeah, how much would you want for a mug that you already own? And people ask for twice as much money to sell a mug they own than they're willing to pay for a mug that's exactly the same. So the endowment effect, the effect of having something and owning it, doubles its value to you. So having a portfolio makes it feel really important. Having a pension makes it feel really important. It makes it hard to compare it to other options that are out there. However, if you build a robust financial plan and put the annuity in, it provides you benefits even outside that income stream. Very often we hear people say, well, if I give all my money to an insurance company, what happens to my kids? What happens to my loved ones? It's all with an insurance company. What if I pass away early? And what's interesting is we've modeled, if you purchase an annuity, you can use a portion of that for life insurance, which is extremely tax efficient and gets rid of any sort of volatility, but it is giving money to a bunch of insurance companies. The alternative is you have this annuity, you've sort of supercharged your CPP, OAS, and pension with this extra stable income stream. So what that means is the remaining money, you can take more risk. We saw that Monte Carlo analysis where you're taking 50,000 out of a volatile portfolio. What if half of that had come from an annuity? That means that your drawdown rate on the remainder is half, and maybe there's a bit of discretion there. If the markets go up, we spend more. If the markets go down, we spend less. So this all ties together. You have CPP and OAS as these stable sources. Some people have defined benefit pension plans. We have our asset allocation, the ratio of stocks to bonds in a Monte Carlo that we're comfortable with. Obviously, saving fees is super important. I went over that. But then also, what portion should I make guaranteed? Is my CPP, OAS, and pension enough? Or should I also add to that with an annuity? And will that benefit me, my beneficiaries, and my spending long time over retirement? those were the key concepts we wanted to cover today. But Brady and I are sticking around for another 15 minutes or so to answer questions.
Great. Thank you very much, both of you. A lot of information to take in there, but very valuable to have. So we have a couple of questions to start us off. And as a reminder to all of our participants today, feel free to go ahead and type any questions you might have into the chat box at the bottom of your screen, and we can cover those off, taking them from there. So the first question is, I see that there are RIF minimums, RRIF. Are there maximum amounts that I can withdraw from my RIF every year? Brady, is that one for you?
Sure. Yeah, no, I'm happy to take that one, Maureen. So I just want to highlight that there is a difference between an RRIF, or Registered Retirement Income Fund, and an LIF, a Life Income Fund. On the RIF, which is the evolution of an RSP, there is no maximum, but there is certainly a minimum once you have converted that RSP to a RIF, that you are mandated to withdraw according to certain tables that CRA has published every year. It is a certain percentage of the account value based on your age that increases, that is designed to increase as you age. The idea is you've gotten RRSP contribution deductions that have benefited you as you've saved for retirement along the way. And they want to increase the withdrawals as you age, because at some point they're looking to recoup that benefit and get paid as well. And that is all taxable to the taxpayer that has withdrawn from it. There is no maximum, there is a minimum. For the LIF, the Life Income Fund, that's an evolution of pension funds that have been accrued. There are minimums and there are maximums pursuant to the jurisdiction at which the pension was accumulated from. So there are provincial pensions and there's also federal pensions, and they are subject to minimums and maximums. So you cannot take out of your LIF fund at free will. Those just come from different rules that govern certain types of money that comes from pension legislation.
Okay, thank you. The next question is, how do I know how much I'm paying in investment fees?
Yeah, I'll answer that.
Sure.
So if you look at any sort of mutual fund document, there'll be a number called the MER. That stands for the Management Expense Ratio. And so what that is a backwards looking metric saying what percentage of the fund's value went towards fees. So this does include things like tax reporting, documentation, the general cost of managing a fund. That also includes what you paid to the team managing that money. And so if we look at actively managed products, they can range from 0.5% per year. I've seen them up almost close as high as 2%, 3% per year, depending on what the product is. And if we look at index products, like the ones I referenced, they can be as low as less than 0.1% per year. So on a large portfolio, that can be the difference between $20,000 a year of fees and $1,000 a year of management fees.
Okay, thank you. And is right now a good time to invest with the markets being at all-time highs?
Take that one, short.
Brady, yeah.
Yeah, no, it's a great question, Maureen. It's something that we hear a lot of. I would take, 30 steps back just before we get into it about, is it at someone has some cash and they're thinking about getting in, but they're hesitant because there's record prices in the stock market right now. And the media is probably playing a big role to remind people that this is the case and that should be of worry, and that there's some impact of gravity that's going to happen and they're going to come down. Number one, when thinking about your own personal situation, I would have a really good idea of what your goals are and what is the actual intended purpose of this money that you're thinking about investing. This comes back to some points that we made earlier about making sure that you have a well-defined, thought-through plan to ensure that this capital, this cash, satisfies an end goal that you're looking to achieve. That's kind of starting point number one. And in thinking through those kind of decisions and getting that plan in place, candidly, you can ask yourself, do I really need to take any risk to begin with? Or is this something that I could sit on and just, and not even have to worry about all this? Now, for capital that has a longer term purpose, it could be for multiple generations of family where it's beyond one's needs, for example. And yeah, there might be an argument where you could take some investment risk in exchange for higher returns above cash and inflation. For these kinds of scenarios, when we're all aware that we're at all-time highs, I think what we want to keep an eye on is the fact that that's kind of the point in investing in equities, is that capitalism is supposed to work this way. And the thousands of different companies that trade on stock markets, they have really smart people that get up every morning to try and improve their business performance and operations every single day. Capitalism is still working in the background, and these all-time highs are expected to keep going up. We did a study not too long ago about the idea of, you might have heard, buy the dip. This is a decision that an investor might have where, you know what, I'm not too comfortable going in with a lump sum of investing right now. I'm going to wait for the market to correct perhaps by 10% or maybe 20%. And then I'll feel comfortable getting in because I'm looking for a lower price. We ran an analysis within the firm. It's called Buy the Dip. We can put it in the chat here if it's of interest. And essentially, it looked at historical results of what waiting for that market correction looked like versus just going in with a lump sum strategy right now, right away. And it tested this comparison across multiple countries. And what we found was, in several trials and circumstances, just going in with a lump sum investment yielded better results over a long period of time than someone that was waiting for a market to correct by a certain amount. And I mean, and Jordan mentioned this when he was talking about the when to invest part. It totally resonates with us, why it might be, you might be nervous going in at all-time highs, especially when that's perceived as something that's not right. I don't believe that. But the other side of this is, if you wait, and if you wait for that market to correct, behaviorally, there might also be stress for money that you feel could be put towards an investment strategy if that correction to the threshold that you're targeting actually never happens. So there's stress on the other side as well.
And another question, so as somebody gets closer to retirement, is it a good idea to keep investing or kind of pull back on the investments either at or after retirement?
So that highlights the importance of the Monte Carlo analysis that we referenced. So we might recommend maybe have less equities as you approach retirement and invest be more of a loaner than an owner in that case. So as you approach retirement, the amount of time you have to put money in is shrinking, and the timeline to where you need to take money out is getting very close. And we saw that bad returns early can cripple a financial plan, regardless of the rate of return over the entire time. One way to avoid bad returns early is to invest more conservatively, as opposed to just not investing at all. So if you have a 50-50 portfolio, then that's suitable for you in the Monte Carlo, keep putting money into it. But if you're all stocks concentrated type investor, maybe invest in something different rather than not investing at all.
Okay, thank you. I think that brings us to the end of the questions. So I'd like to thank Brady, Jordan, and Stuart for joining us today. I think the information that you shared was very extensive, very valuable. I hope that our audience found it so as well. And thank you, everybody, for the questions that you put forward. I think this recording will be available to others as well who weren't able to attend today. But thank you again for everyone taking the time to be with us, and we'll look forward to seeing you again on our next webinar. All the best and see you later. Bye.
Thank you.